Hello and welcome to another edition of Capital Calculus. I'm your host, Anil Padmanabhan. A few weeks ago, the prices of gold recorded a lifetime high of $3,000 per troy ounce, and it has stayed there ever since. Not surprising, given the fact that gold prices have surged by as much as 40% in the last 2 years. Yet, the appetite for gold continues to grow. To unpack the underlying trends driving this surge in gold prices, I spoke to John Reade. He's the market strategist for the World Gold Council. I began by asking John as to why gold prices have surged so dramatically in the last 1 year in particular.
As usual with gold, it's not one thing, a combination of things, really. I would describe the two main reasons for the strength we've seen in gold is demand, firstly, demand from emerging markets. So emerging markets make up nearly 3/4 of consumer demand for gold. And we've seen strong buying from emerging market investors. We've seen strong buying from time to time from jewelry buyers. We've seen strong buying from emerging market central banks, continuing a theme that we've seen since 2022. And emerging market investors seem to be buying gold for reasons that are more related to domestic factors rather than following the US dollar or following the US interest rate cycle, but very much due to conditions in their domestic markets. The second thing, of course, has been geopolitics as well. And that's been responsible, I think, for most of the gains that we've seen this year and maybe late last year as well, following the election of Donald Trump and some quite extraordinary political developments that have taken place in the United States. Risk and uncertainty is a big driver of gold. And I think uncertainty, particularly, is extremely high at the moment, and risks probably not far behind.
So, John, when you mentioned emerging markets, I presume you're talking about China and India, which are very dominant in the gold market, right?
Yeah, I mean, China and India make up 50% of demand for gold, and clearly, strength in China, strength in India is really important. They're not the only countries, though, and we do see from time to time buying from other countries becomes really important. Probably not for as long, and not through the course of a whole year. But for example, around the presidential elections in Turkey, when we saw tremendous buying by Turkish domestic investors and savers trying to protect themselves from expected currency depreciation that would follow the results of the presidential election. So for a while, Turkish gold demand was really important. I mean, it's always a fairly big market, but it became enormous briefly. And that's a good example of how other emerging markets are playing a role as well. I guess the other point as well is that emerging market central bank buying, although India and China have both bought gold, but emerging market central bank buying is much broader than the spread of consumer demand for gold. So there's lots of emerging markets which perhaps don't consume as much gold at a retail level, but have bought good amounts. And I'd point to Poland, for example, Hungary a few years ago. So yes, you can't ignore India and China. We pay more attention to those two markets than probably any other market. But other emerging markets have been really important too.
So you also mentioned the fact that the domestic factors are inspiring this demand from emerging markets. So let's take the example of India. What is the domestic factor which is motivating demand, and similarly in China too?
Sure. I mean, I guess the biggest news in India last year, which really did prompt some very strong demand in the second half of the year, was the unexpected cut in import duty that took place at the beginning of July. I mean, gold suddenly got 9% cheaper overnight, and Indian purchasers who had stood back in the second quarter after the gold price started to really rocket came into the market and bought good amounts in the third and to a lesser extent the fourth quarter of 2024. Underlying demand in India remains decent, but like most markets, we see when demand is dominated by jewelry demand, then high prices do tend to result in less volume of gold purchased, even if the amount of money being spent on that gold goes up. I think the other factor that we're seeing play out in India as well is the development of an investment market in ways that we haven't really seen before. So ETF inflows in India have become quite prominent in the last 18 months, a trend we expect to continue. And that's certainly something we welcome because, in my view, and perhaps in the view of the World Gold Council, a healthy gold market is one that is balanced between jewelry demand and investment demand. So when prices are high, you probably get less jewelry demand, but investment demand is stronger, and vice versa. So that makes the demand from a country more stable. Now, historically, India has obviously been dominated by jewelry demand. We are seeing good growth coming through both in physical investment demand for gold, but also through financial channels like ETFs.
Oh, very interesting. So tell me something, John. In India's case, what is the proportion of investment demand and especially ETFs in
Yeah,
overall demand?
ETFs are a small component at the moment of overall investment demand. Overall investment demand probably sits between 20 and 30%. And that's grown quite considerably from perhaps the 10, 15% that we might have seen a few years earlier. ETFs, as I say, are still a small component, but one that is growing rapidly. Something that actually we've seen in China as well, where I think that although ETFs have been around in both India and China for years now, they're only now beginning to get traction. And I think that's because investors are looking to diversify into gold via any channels they can.
Why has central banks, say the Reserve Bank of India in India's case, buying gold? You said it's a trend which began in 2022. I think in India's case, it's even earlier.
Yeah, I mean, central banks have been buying gold on a net basis, so collectively you add all the central bank activity together. Central banks have been buying gold in aggregate since 2010. What happened in 2022 is the rate of purchases increased. So between 2010 and 2021, central banks bought an average of just over 500 tons of gold a year. So, that's a bit more than 10% of the gold market. What we saw in 2022, though, is that those purchases doubled. So for each of the last 3 years, we've now seen 1,000 tons of central bank buying. So, making up 20% of the gold market. And that's a big jump. Now, the central banks that are buying are almost exclusively emerging market central banks. We've seen one or two developed market central banks buy gold on occasions, but this is mostly an emerging market story. And there's a number of reasons behind their purchases. After the global financial crisis in 2010, I think emerging markets recognized the benefits of having gold within their foreign exchange reserve profile. And for historic reasons, they built up trillions of dollars of foreign exchange, but hadn't added gold to their holdings. So from 2010 onwards, we were seeing a move towards diversification into gold. But in 2022, the world changed somewhat when Russia invaded Ukraine, and then sanctions were placed upon the Central Bank of Russia, locking up its foreign exchange reserves in the financial systems of the United States, Europe, etc. I think then central banks realized that they probably didn't want to depend upon countries that might turn against them under certain circumstances for all of their financial assets. So we've seen emerging market central banks accelerate the purchases of gold as a consequence. Now, if you consider the developments that have been taking place in the political system over the last few weeks, I think there's a lot of countries that thought they were allies of the United States, but may no longer be so sure about that. That's probably going to accelerate this trend of central bank purchases, simply because the US doesn't look as stable and trustworthy and reliable as it has done perhaps 2 or 3 years ago.
So, John, how does this stack up for the investment demand? say in emerging markets, like central banks, you explained, are diversifying their portfolio and they're hedging against geopolitical risks. But what is the motivation for investment demand, particularly in emerging markets like India?
Well, if I take emerging markets in general, I think there is a recognition, first of all, that gold has performed very well. And there's nothing like a rising price to get more headlines in the newspapers, more people thinking about investing in something that's going up. Um, I don't think it's the case in India that there's no alternatives. I mean, the Indian economy is still growing nicely. The stock market's performed well until perhaps a bit recently. But in general, India is a good news story rather than a more difficult economic story like we've seen in China and some other markets. So I think the price performance has been a big driver of this in India. In the case of China, as I outlined, it is an attempt by Chinese savers to get out of their exposure to the domestic currency. And the one way that they can do that is obviously by switching the domestic currency into gold. And we see that quite often, particularly if a country has quite tight foreign exchange controls, which they do in China. Other countries, it can be short-term economic factors, it can be short-term political factors. And that's why it's really difficult to generalize. I mean, lumping together lots of countries under emerging markets might be useful as a label, but it doesn't describe common behavior all of the time. And that's certainly the case in investment in gold.
How does the return stack up on gold in general?
Well, it depends over which period you look. There's been quite a lot of work I've seen recently, people publishing studies since 1900 and looking at the returns of all asset classes. And that's fine, but I'd argue that it's only really relevant to look at the returns of gold since we came off the gold standard in 1971. Prior to that, gold was money. It was linked to money, and the price of gold was frozen against the US dollar. But since 1971, gold has delivered returns which have been better than most asset classes. I think the average US dollar return since 1971 is something like about 8%. And equities have been slightly better than that, but every other asset class has been worse. And that's the same pattern that we look at. I've got the numbers in front of me here for the last 20 years and the last 10 years. And in the last 20 years, we've seen average returns of just shy of 10% in US dollar terms for gold. And again, that's better than everything else apart from US equities. So we're looking at an asset which has a reputation of performing well during difficult times or during times of high inflation. And that's true. But it's also an asset that can perform well over the longer term as well. There have been periods when gold has delivered poor returns for quite a long length of time. And those have generally been associated with peace, prosperity, high productivity growth, and positive feelings regarding the global economy and its integration and development. So the mid 2000s, for example, was a period when gold wasn't performing particularly well. But in this environment that we're faced now with a lot of risk and uncertainty, both political and geopolitical, probably higher inflation, probably lower economic growth, gold's returns, I doubt they'll match what we've seen in the last 2 years of 40%, but I suspect that they will do well both on an absolute basis, but also relative to other asset classes as well.
John, if I've understood you right, you said the pattern of demand, particularly in emerging markets like India, is changing with the rise in investment demand, which is over and apart from the demand for jewelry. So are we and buying by central banks? So what you're suggesting is that there is a structural shift in the nature of demand, right?
I think that's right. And I think we've seen that over the last 30 years. 30 years ago, the gold market was dominated by jewelry demand. Something like 80%, 90% of global demand was from jewelry demand. And Western jewelry buyers were really important. Europe was a huge market. The United States was a huge market. Japan was a huge market. So emerging markets were a lot smaller components of the gold market back then. Now, if you look at where we are now, I mentioned before, nearly 75% of demand is coming from emerging markets, but the breakdown of total demand globally has shifted. Now we're in a situation where investment demand over the last 10 years has been just a bit higher than jewelry demand, about 42% versus 37%, something like that. So this is a market where investment demand has become much more important. It's a market where central banks have been buying now for the last 15 years, but prior to that, they'd sold gold for 21 years in a row. I mean, the only thing that doesn't really change on the demand side is industrial demand or technology demand for gold, which has always been about 6 or 7 or 8% of total demand for gold. And even though you see positive headlines about how tech demand for gold is being boosted by artificial intelligence, that's true. But over the longer term, we've always seen industrial demand for gold at around current levels in proportionate terms. So the big shifts that have happened is that gold demand has moved towards emerging markets and to become more balanced, split between jewelry demand and investment demand.
Can we then stretch this argument to ask the question whether gold is emerging as an alternative financial asset in a country like India? Because I asked this about India because we are seeing an increasing trend of financialization of savings, which
Yeah.
is, unprecedented, what we have seen in the last 5 years.
No, very much so. And it's one of the things that we're very keen at the World Gold Council to encourage is as India financializes and as its investment market becomes more conventional, so investing in equities, investing via mutual funds, etc., don't forget the benefits of having an appropriate amount of gold in your investment portfolio. And in fact, if we look at historical returns and performance, then the target weighting for a typical Indian portfolio is actually a bit higher than it would be, say, in the United States or Europe. And that's probably because of the trend of slightly higher inflation and rupee depreciation over the longer term. So I know a lot of Indian citizens will think that they have exposure to gold through jewelry, and that's true. But within an investment portfolio, they shouldn't neglect to have gold there as well. And we find as we look at portfolios around the world over different time periods that having somewhere between, I don't know, 8% and 12% of a portfolio in an investment portfolio in gold of one form or another really does help the performance and the risk adjusted performance of that portfolio. So Indian investors from that perspective are the same as investors around the world. Is yes, they should financialize, they should be investing in financial markets, but they should not neglect the need for an appropriately diversified portfolio. And gold is a great diversifier, particularly of equity risk.
John, to go back to your opening remarks where you said one of the factors influencing this sharp rise in gold prices is global uncertainty and geopolitics. Can we also assume that this price run is also warning all of us that the global economy is also not in a good place?
I'm not sure that it's saying that the global economy is not in a good place. I think it's saying, though, that the risks are that there could be a deterioration, and perhaps a deterioration greater than is being factored in by other financial markets. We have seen a bit of a correction in some equity markets, particularly the United States, but also valuations remain pretty high. Gold price is telling me that risk and uncertainty is high. The equity market's saying it's not. I tend to believe the gold market a little bit more because it seems to be a little bit more international in the way that it takes into consideration these risks, whereas particularly the U.S. equity market is driven very much by domestic sentiment. And to be frank, I'm not quite sure how much America understands about the rest of the world, particularly at an individual level.
So, given that it's the bellwether for risk, what is the likely scenario for gold prices, say, in the next 6 months?
I've said on a number of occasions, both in writing but also on television to journalists, I feel less confident about making predictions about anything now than I have in perhaps the last 30 years of my career, simply because the rules by which US politics has been played by, and face it, the US is still the most important economy in the world. The US dollar and US financial markets are dominant. We're now seeing statements, policies, executive orders at a tremendous rate, and almost irrespective of whether they will be deemed to be eventually legal or not. That makes it really hard to make predictions about economic growth, inflation, whether the US dollar will strengthen or weaken. What I can say, though, is if I look at how gold has behaved over the last year, slightly more than a year, every time there's been a correction in the gold price, for whatever reason, whether speculators maybe have got too much gold at one time, or perhaps the dollar strengthens or interest rates move, and you see what looks like a trigger for a correction. The corrections that we've seen have been shorter and shallower than market observers like myself would expect. And I think that fact is reflecting that there is strong demand for gold sitting beneath the market, whether that's from central banks, whether that's from investors, whether it's from jewelry markets if the correction is deep enough. So we don't forecast the gold price, which sometimes can be annoying, but at the moment I think it's quite useful because forecasting prices is really quite difficult. What I would say, when we published an outlook document in December of last year for what we were expecting this year, we were expecting, on balance, looking at a number of different economic scenarios, we were looking for modest upside in the gold price. That modest upside in the gold price has been exceeded already, because I think that the political situation is more volatile than we expected. I personally expect that volatility to continue, but it's difficult to make a case for gold prices going materially higher from here unless one of two things happen. If central banks, who have been such important buyers in the gold market in the last 3 or 4 years, if they increase their purchases further, that can help gold trade higher from here. And the second thing is, as well, I've mentioned a lot about emerging market investment demand for gold. If we see Western investment demand for gold return and emerging market demand for gold continue, then that could provide the necessary ingredients to take the gold price higher from these levels. Now, so far, the jury is out on Western investment demand. ETF inflows turned positive about 9 months ago and remain positive today. The rate of increase is good, but not fantastic, but it's better than outflows. But the bigger and more important physical bar and coin demand market in Western Europe, in North America, remains soft. And if that doesn't improve, then I would be looking at this gold price with some caution.
Great, John. So if I understood you right, what you're saying is that there is latent demand beneath this, even though prices are so high, but they will get triggered only in certain circumstances, which we can't predict at this stage, given the state of the world polity, right?
I think that's right. One thing that will help, lower interest rates in the West should mean gold demand picks up. And I think everybody is expecting interest rates to fall in Europe and North America. If we get a recession in the US, which is becoming increasingly likely as confidence declines in the US economy, that would help too. But as you say, these are difficult things to predict with accuracy. And there is no doubt that a gold price above $3,000 an ounce is, first of all, very high. And second of all, much higher than any of the professional forecasters were expecting 12 months ago.
Clearly, gold prices have surprised on the upside. Even analysts have been caught by surprise. Given the state of play of geopolitics and the uncertainty around the global economy, especially in the backdrop of the Trump tariffs, gold will continue to be a safe haven. At the same time, there is a clear shift in the pattern of demand from emerging markets like India. They are moving away from jewelry to investment demand. And why not? The average return on gold for the last 10 years is around 10%. As they say, all that glitters is gold. Thank you for watching. Don't forget to subscribe to StratNewsGlobal.Tech on YouTube. Hit the bell icon so that you don't miss any updates. And please, to share your thoughts, ideas and suggestions with us, I'm available on Twitter at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.